National webinar, Staying Focused in Volatile Times, Managing Investment Risk. My name is Deirdre McElroy, and I serve on the SEAP Planning Committee in Endowment and Finance tracks. Thank you on behalf of the SEAP Network to our attendees, and thank you to our financial experts today with Zevin Asset Management joining us from Boston. We will be accepting questions for this webinar in the chat section, so feel free to send them and we will be getting to as many as possible. The SEAP Network is pleased to offer this series of webinars for key financial roles. The next one will be on April 20th at 3 p.m., 2 weeks from today, Behavioral Finance and Investment Committees. We continue to advise you all to stay calm, stay connected, and seek opportunity. And so now, let us pray. Holy One, we are your people inspired by your Holy Spirit. We know when we live in your inspiration, we are already equipped for shaky times. Let us gathered here inspire, connect, and equip one another. Again, we ask you to lift up those in distress, sustain those who administer, strengthen those who steward, and fill us with the hope of your new creation through Jesus Christ, our rock and our Redeemer. Amen.
Amen.
Let's get our speakers and friends introduced today. We've gathered two SEAP contributors and financial experts for you. Both attended SEAP 2020 in Louisville. Both are fine and well and feeling good. And you may have encountered their teachings in both our endowment and our newest track, Parish Finance. Sonia Kowal is the president of Zevin Asset Management with responsibility in corporate matters, business practices, and strategic planning. She is a member of the firm's investment committee where she incorporates sustainability issues into investment decision-making. She is currently on the board of the Interfaith Center on Corporate Responsibility, or ICCR, friend and contributor to many of our Episcopal endowments. And ICCR is a coalition of faith-driven organizations who view the management of their investments as a powerful catalyst for social change. Sonia is a mentor for disadvantaged youth through Year Up, and she has been a SEAP gathering supporter for 4 years. Welcome, Sonia. Kevin Callahan is a senior portfolio manager and equity analyst at Zevin Asset Management. He is also a member of the firm's investment committee. Kevin is actively involved in managing investment portfolios and client relationships for institutional clients, including Episcopal parishes and entities. And he promotes corporate practices that support economic, social, and environmental justice. Kevin states that taking an inclusive approach in our endowments involving all of our stakeholders generally leads us to long-term sustainable outcomes that can benefit the overall community. He's a faithful soul. Kevin volunteers at St. Francis House and as a financial literacy mentor at Year Up.
Thank you, Deirdre.
We understand you'll both be speaking with us about risk today. Do we as institutional investors need to define our risk?
Absolutely. Thanks, Deirdre. And thank you to SEAP for hosting this webinar and for all of you for tuning in today. So it's obviously better to prepare ahead of time for economic and market downturns, but the good news is it's not too late to make sure you're well placed to weather this proverbial storm. For those of you that don't know, Zevin Asset Management is a Boston-based investment firm that serves faith-based clients, schools, and high net worth individuals. And we manage portfolios aligned with our clients' investment goals and values. And we're most known for the conservative way that we manage client portfolios. We are 100% employee-owned and majority women-owned. And we're also a B corporation. And that means that we have a designation and certification that shows that we hold ourselves to the same high standards that we expect from the companies in which we invest. So today we'll be talking about managing investment risk in terms of crises. And so we plan to talk for about 40 minutes and allow ample time for your questions. And if there are any questions after the call or those that are best shared privately, please feel free to contact us by the means listed at the end or through our website, and we'll be in touch. So suppose that 3 months ago, someone had asked you what the probability was that a virus would cause the stock market to crash in 2020. And not even a computer virus, mind you, but a protein molecule. And you might have said that that probability was minute, just like the other things in this cartoon. So we can definitely go overboard in worrying about too many risks, but at the same time, it's really important to define and prioritize the risks that your assets face in a practical way. So that being said, how can you protect your endowment and what can still be done in these strange times? And that's what we're going to talk about today. So this slide has 1 or 2 definitions of risk. So it's commonly thought of as that possibility of suffering harm or loss and some sort of danger. But truthfully, it's not that simple. It's usually quite complex for most organizations. And so in a budgetary or financial context, risk can mean really different things to different people, even people that are in the same investment committee or board. So you really need to explore thoroughly what risk means to you first before you try to begin to control for risk in your portfolio. In your next board meeting or next investment committee meeting, maybe think about adding risk as an agenda item. And it can be as simple as asking, what existential risks do we face with our finances? And what are the primary investment risks that we have to mitigate? And that conversation can be quite illuminating.
Thank you, Sonia. Kevin Callahan, I'm going to turn the mic to you now. You work closely with endowment and investment committees. What are some of the risks our endowments are carrying, and when is the right time to panic?
I'm not sure there's a good time to panic, but well, first of all, thank you, Deirdre, for having me. Thanks, Steve, and thank all of you for participating today. I think the short answer on the panic side is there's never a good time. But as you can see on this slide, we have a whole laundry list of risks that you potentially have to deal with. And I'm not sure if you all realized that there's so many risks out there, but these risks, they're not insurmountable. It just takes a little planning. The first risk that I just want to touch on is liquidity risk. I think this is one of the most important ones. And I think even today, when we're going through a crisis as we are, I think liquidity is very important, and it warrants being reassessed continuously, because you want to know if you can get the cash that you need for your projects, from your endowment, whatever types of things that you're involved in. You want to make sure that you can access the cash. So whether it's and when you're thinking about liquidity, I think there's 2 sides of it. One is your investment portfolio. You want to make sure you can get the cash. But the other side too is you have to think about your own parish. How are things going to change because of this crisis? Are there certain projects that you may delay? Are there some projects that you want to speed up? And also, what type of impact might it have on fundraising? So these are all things that I think you need to consider when you think about liquidity risk. The second risk that I want to touch on is investment risk. And this really highlights the amount of your portfolio that you invest in. And it also highlights the types of stocks that are in your portfolio. And just as a gross generalization, the more stocks that you have in your portfolio, the more risk. But there's more expected return. And we'll get into some of the details a little bit later. The third risk that I want to touch on, and Deirdre highlighted this to begin with, is the panic risk. And this is one that I think we all face in some degree. It's this is something that we need to try to get right, though. And we're clearly being tested right now in the current crisis. And I just want to touch on 2 stories with regard to panic risk. a panic risk in an up market and panic risk in a down market. In terms of the up market, this happened about 10 years ago, and it was a very large parish. Actually, it goes back 20 years ago to 2000 to the year 2000. And I don't know if you all can remember back then, this was the dot-com bubble, and everything was about tech, media, telecom type names. And this one very large organization had an investment portfolio in equities of about $100 million, so very large. And they had held out investing in all these tech, media, telecom names until 2 months prior to the bubble being burst. So the net result was their portfolio that started the year at $100 million ended at $50 million. It was cut in half. What they ended up doing was they had a portfolio filled with high quality blue chip companies, and they decided to sell them all and invest everything in all the high tech names, the AOLs of the world, et cetera. So it's, you know, a lot of people think about crisis happening only on the way down, but this happened on the way up. Another story, this is just 10 years ago, back in the Great Recession, 2008, 2009. In the fall of 2008, a client, you know, calls me up first thing in the morning. It was the first call, 7 a.m. They hadn't been able to sleep for several days, and they just said, you know, we got to go to cash. I can't take it anymore. I'm so concerned that we're going to lose all our money and we're going to lose all our programs, et cetera. We just have to go to cash. And while I tried to counsel the person to focus on the long term, we had a plan, et cetera, I just couldn't get the person over the hump. And the net result was we ended up selling. We ended up converting the portfolio to cash. And then over the course of the next couple of weeks, the stock market rebounded 15+%. And at the end of that 2 weeks, the client came right back and said, you know, I want to get back in the market again. And I think it's important to be aware that emotions do play a part in this and to try to manage your emotions as best you can. It's easier said than done, but try not to let panic risk get the best of you. Then what I'd like to touch on next is just a little study that I did as I look back on the stock market over the past 30 years. And as you're all probably well aware, that the stock market is influenced by a lot of different factors: economic factors, psychological factors. And clearly, as we're seeing over the past month or so, in the short term, it can be very volatile. You know, short-term issues, coronavirus, clearly a big issue. 10 years ago, it was the real estate financial crisis. 20 years ago, we had the dot-com bubble. We've had numerous of these, and there have been smaller ones in between. But as we'll see in just a moment, in the long run, the stock market has tended to move higher. It moves higher up and to the right over time. But clearly, there can be a lot of volatility as we're all experiencing. So my advice to most everybody is invest for the long term, but plan for the short term. And when we think about short term, that's where liquidity and investment risk come into play. And a very important point is, as far as the liquidity side, make sure you have enough short-term investments, that's cash, treasury bonds, things like that, for 3+ years of expenses. Whatever you're budgeting, whatever you're planning, make sure that that's in cash, treasury bonds, something that's easily convertible into cash, and the value is not going to go down, or it won't go down by much if we are in the midst of a crisis like we currently are. The last point is I tried to examine stock market pullbacks, and I looked at the pullbacks anywhere from 10% down to 50%. And I focused on the two largest ones. And again, those were the ones back in the dot-com bubble, 2000 to 2002. And the second one was 2008, 2009. During both of those crises, the stock market fell by about 50%. The important thing that I want you to take away is the stock market did come back. It did bottom out, and then it did start to rise. But it takes time to come back. And what I tried to measure is I focused on what was the peak prior to the market falling in both 2000 and in 2008, and how long did it take from that point to get back to that high. And for these two crises, and again, these were the worst that we've seen in over 30 years, it took 4 years, 4.3 years, and 6.8 years. So my point is, in sharing this with you, is that even in very dour situations, the stock market does tend to come back. But when you're planning, make sure you think about how long you think it will take. Is it going to be 4 years? Is it going to be 6 years? Plan for that, and you'll feel much better the next time we go through a downturn. I'm trying to share this chart, and the first thing I want you to look at, this is the S&P 500, and I show it over the past 16 years. And as I mentioned on the prior slide, the trend tends to be up and to the right. As you'll notice, it's not a straight line. There's a number of ups and downs along the way, but it does tend to trend higher over time. What I would like to recommend is that if you don't need your money today, if you're worried about this crisis, you're thinking about your investment portfolio, if you don't need any extra money today, stay invested. I think if you sell today, you're going to miss on the potential gains that will come over the next several years. I'm not anticipating that the market's going to rebound in a month or even 2 months. I'm anticipating that it'll be more longer term, and as long as you have enough money to tide you over during these challenging times, I think you will be much better off in the long period. So if you don't need the money, stay invested. The last point I want to make is that when you think about your portfolio, different portfolios rise and fall depending on their investment style. At Zevin Asset Management, we tend to be more conservative in how we invest. And the net result of that is that when the stock market does go down, we go down as well, but we don't tend to go down as much. And on the upside, we don't tend to go up by as much. But the big benefit on the downside is when you do go down, we don't go down by as much, so we're saving you money there, and you're able to get back to the level that you were at before much quicker. So we tend to be more conservative. We tend to hold on to your money or save it. And I think that's a pretty good investment style for people to think about, whether it's with Zevin or someone else.
Thank you, Kevin. Thank you for reminding us to be downside risk aware, prepared for our short-term needs. And also, that was really useful for putting the long-term market in context. Can you help us now with our game plan? What kind of changes, if any, might we consider at this time?
I think that's a very good question. It's always important to revisit your game plan. Even in the midst of a downturn, that's when we tend to take a closer look at it. But as we get through this crisis and we move along in future years, it's always good to review your game plan at least once a year. Hopefully more often, but at least once a year. But as you think about your game plan, go through your goals, think about the timing of when you want to spend some money, when you need some money to spend, and think about your risk tolerance. This may change over time. And something that you should do is, as you work with your investment advisor, they should be able to help you with this. They should be able to help you create a plan and help you to monitor that plan and modify that plan as things change for your organization. It's always, like today, what is the impact that the coronavirus is having? We touched on this a little earlier. It's just what impact is going to have on your programs, any events that you may be having, any fundraising. That should all be incorporated into your plan on a go-forward basis. And your plan, it really is a living document. So if things change and it makes sense to change it makes sense to modify or change that plan, then modify it. You don't have to stick with it as things change over time. Possible changes that you can think about. You can rebalance your portfolio. So what that means is really, if prior to the crisis, and I'm just going to throw these numbers out, you invested about 70% of the portfolio in stocks and 30% into bonds or short-term cash type investments. Today, with the market down 20, 25, 30%, depending on the day, because we're experiencing a lot of volatility, at some point you may want to think, because your equity has probably gone down, maybe it was at 70, maybe it's at 60% now, at some point you want to think about maybe scaling back up towards that 70%. But again, you need to do that in the context of some of the other risks that we've talked about, the liquidity risks and the investment risk for you, for your situation. If you end up being in a position of weakness, which is kind of what example number 1 highlights, you may need to reduce your stock ownership further and increase the percent that you have in bonds and cash. If for some reason you're in a strong position, you're operating from a position of strength, maybe it could be example number 2. Maybe you could increase your stock ownership, decrease bonds, because over time, if you looked at the chart that I had up just a moment ago, if you were to invest at the low point or near the low point, when everybody was kind of running for the doors, the returns that you were able to achieve over the next 5 or 10 years were much higher than if you wait for the market to recover before you were to reinvest back into stocks. It's tough to do, but that's generally when people tend to be most nervous and the stock market tends to be weak, that tends to be very good buying opportunities into stocks. So you really do need to be as objective as you can, because emotions can definitely cloud your decision making. And again, you can work with your investment advisor on this, and your investment advisor should be helping you right along the way. And lean on that investment advisor, especially during uncertain period of time, because they have a lot of experience and they can help hold your hand during these situations. So a couple of things to remember. Every savings and investment product has different risks and expected returns. What's right for you and your parish? You need to decide that, along with having your financial advisor help you. There are trade-offs, and I try to highlight some trade-offs here on this slide. On the left-hand side, you can see generally lower risk, conservative type investments, and on the right side tend to be higher risk, more aggressive, but higher potential or expected returns. And in the current crisis, as probably no surprise to you, the right-hand side tends to be down a lot more than the left-hand side. So allocating your money amongst these buckets will determine what your investment risk profile is. You don't have to choose just one bucket. You can mix and match. Make sure that the mix is right for you. And again, this is something you can work with your advisor, and they should be helping you to figure out what the best mix is for you.
Thank you, Kevin. You're always very teacherly, and we appreciate these points. We need something that constitutes a checklist, things that we can do right now and ways that we can be proactive. And we know that Zevin is going to give us those goods today. So if you could pick that up, that would be splendid.
Yeah, I think having a roadmap is always good for all of us, especially when you get into uncertain times. A roadmap becomes even more important. As you think about it, if you were driving around, and this is kind of before Google Maps and everything, if you were driving around and you're totally lost, having a map is very helpful to figure out where you need to go. And just like if you're driving, having a map to help you figure out how you should position your investment portfolio is key. So one of the things that you should work on is crafting or creating an investment policy statement. It's Again, your advisor can help you create one of these, can give you samples, and once you have stuff written down, it changes everything. I've worked with so many different clients. We have numerous conversations. I think we're on the same page. They think they're on the same page. And then I put it down in writing and I say, this is the game plan. And it's amazing how many times the client I'm sitting across from will say, well, you know, I didn't really think we were going to quite do that. So I think my point here is that having a roadmap is good. I think it's very important to get it in writing so that everybody can see it there and everybody can agree to it. Another point that I want to highlight on this checklist is just, again, it's the liquidity measure. It's point number 4 down there. Establish liquidity measures that protect you. Again, you want to have access to enough money in the short term, and you want to have at least 3 years worth of money in cash, short-term treasuries, or similar types of investment products. The last checklist point that I want to highlight here, and we can go into more if you have questions, is just the don't panic. Again, emotions can really cloud decisions, so you need to be prepared ahead of time, ideally, so you can take advantage of a crisis. You don't, and as you managing your portfolio, you don't want to position, or I don't believe you should position your portfolio at extremes. I think you want a balanced approach. And as I shared earlier, people tend to get too excited on the way up and then too excited on the way down. So if you have a balanced approach, I think you'll be better off in the long term. In terms of proactive steps that you should think about, dollar cost averaging is one that I think is not only good for your parish, but I think it's good for individuals as well. And I think right now is a great time to pursue, given the uncertainty. If there's a lot of money, if you have extra money lying around and you have a long-term time horizon, then I think making regular contributions to your investment portfolio over time is a great strategy to pursue. Again, this is a long-term investment strategy. If you need money in the short term, in the next 3 to 4 years, this is not what you should do. But that money that you can put away for the long term, this would be a good strategy to pursue, especially during uncertain times like we're experiencing today, because you just don't know whether the market's going to be up 5% or down 5% today and tomorrow. This way, you just invest some money a little bit every month, every couple of weeks, and just do that consistently over time. Another proactive step that you can think about is thinking about environmental, social, and governance factors. There's a number of companies out there that are thinking more and more about sustainability and aligning how they run their business. And some of the companies that run into some of these risks, such as Wells Fargo, who you've probably read about in the newspaper over the past couple of years, which encouraged their staff to open accounts without a customer's consent. Or we can think about a company like Pacific Gas and Electric, whose equipment started numerous wildfires out in California. These are some of the ESG risks that exist out there, and they can really negatively impact your investment portfolio. And Sonia will give you some more in-depth analysis of this.
Well, Sonia, you taught us at SEEP 2020 and 2019 that the ESG investing universe may carry less risk than traditional counterparts. So please say more about that and share some of what we learned from you in February.
Sure. Thanks, Kevin. Thanks, Deirdre. So in a previous life, I was an analyst researching companies in emerging markets. And what I found was that environmental, social, and governance issues mattered in the long run, even if we didn't see the repercussions every quarter in the numbers. So it's really about looking for all the skeletons and what might go wrong. And it's about looking at the whole picture to make better investment decisions. So I think about it as the real world incorporation of non-financial information into financial issues eventually. And really, being a good corporate citizen can be especially relevant in times of crisis, and can incorporate things like regulation, reputation, and social license to operate. So we're really seeing that come to the fore right now. And the importance of looking at these factors has been borne out by the research. There was a study in 2015 by Oxford University where they did a lot of analysis and showed that a robust sustainability practice results in better operational performance, and then that ultimately translates into better cash flows. So we do meticulous environmental, social, and governance research on companies in order to look under that surface and discover the issues that are bubbling underneath and that will become financially material in the future. So one example is the opioid manufacturer. They've had false marketing and over-aggressive selling fines over the years. And those are issues that we take pretty seriously in research. So if you look at the big picture, if you looked at this information properly ahead of time, you could have seen a major issue around the overselling of painkillers. And this kind of research can also help us identify companies that help the world mobilize around and produce goods and services for a sustainable future. So a more positive perspective for companies. So you may have heard of something called the United Nations Sustainable Development Goals, the SDGs. So we strive for alignment with those sustainable development goals in portfolios, and that's a path towards sustainable global prosperity. So all this information that we research and we know about companies in which we invest, about their risks and opportunities, can also be used for action, right? To push companies to be better corporate citizens, which ultimately we think will make them better investments for our clients. And we call that a type of shareholder advocacy, and we call it active ownership, because it signifies a responsibility as a share owner to improve the companies in which we invest, rather than just to profit off them. So we're known for our ability to convene large groups of investors and use that mechanism of shareholder proposals to increase pressure on companies to respond positively. So,
Sonia, workforce protection is such a hot issue right now, especially with coronavirus. If you can share a little bit more about the social advocacy work you did pressing for improvements for workforce protection, paid sick leave, family leave.
Yeah, so big companies have a major role in the liabilities around and the response to this COVID-19 crisis. So the pandemic really underscores the materiality of a number of social factors, such as workforce health and safety and paid leave practices. A lot of large companies still don't have paid sick leave policies, so we're trying to push that so that workers don't have to go to work sick. It's bad for them and it's bad for everybody else. And we think it's bad for the companies, right, at the end of the day. And the differences between those companies that take care of their workforces and their communities and those that don't will become increasingly clear. And investors can use both their capital and their engagement to push for change there. So in the table that you can see on that slide, under the social part, employers are reeling about what to do with their workers in the absence of demand. So we've sought to invest in companies with relatively strong employee relations and benefits. And we've pressed companies like Kroger, the supermarket chain, Home Depot, Starbucks, CVS, TJX to improve their benefits for over the years, whether that be through paid sick leave, paid family leave, around minimum wage payments. These are all really important things for these companies to consider, and I think they are getting a little bit better. On the environmental front, we've pressed companies like Pepsi, UPS, and others to develop what we call science-based climate change targets. So these are targets that aren't just pulled out of thin air to look good in a corporate social responsibility report. These are targets that are actually aligned with the Paris Agreement. And we also press companies like Kroger and Costco on monitoring for deforestation in the supply chains and being vigilant of issues in the meat supply chain. And in terms of governance, that can also kind of go side by side with human capital management, labor relations, and worker safety. We think that these issues are correlated with morale and lower turnover costs in the long term. And we've pushed companies to disclose and address those gaps between CEO pay and average worker pay, and start to think about that divide a little bit more. So before you start to push for increases in CEO pay, start to think about what the trade-off is against improving labor standards potentially first. So these are all the kinds of things that we think about and weigh up when we're looking at environmental, social, and governance opportunities and risks in client portfolios.
Thank you for sharing that, Sonia. I can imagine that many of our parishes and Episcopal entities have missional goals around social, environmental, and governance matters. We're very pleased to hear about the body of work that you all are doing in that regard. Now, Sonia and Kevin, and share the mic if you need to. Let's get us into action planning.
Okay, in terms of the action plan going forward, what should you be doing today? What should you be thinking about? And again, we've already highlighted there's many different kinds of risks that you need to consider. I think you need to sit down, spend some time, and think about which risks matter most to you. I suspect liquidity risk is a big one for most people, but it may be investment risk, or it may even be more the panic risk, or it could be one of the other ones that we highlighted. But regardless, whichever one you think is most important to you, spend some time, think about it, and focus on it. If it's liquidity, focus on liquidity risk. Now, the second bullet point that we have there is the worrying about a financial crisis should help you survive it better. This is great advice, it's sage advice, but it's probably a little late today to be thinking about that, right? But maybe for the lesson for future days is to worry about the financial crisis before it happens so that you're in a position of strength as you go through the financial crisis. Because these financial crises, they do occur. We haven't had one for 10 years, which is a long time. They usually happen every 5 to 7 years. But it is something that does occur, and we've always done well coming out of it over the long term. The second part of the action plan is, again, as I think I've been hammering home, have a roadmap, have a plan, talk to your advisor, have your advisor help you create that plan, but also have that advisor make sure that you stay on track. That should be part of their role, to help you manage through these challenging, uncertain times. And the last point, I've just noticed that ESG factors have become more and more important to both companies and investors over time. So I think it would be very wise of all of you to keep ESG risks top of mind, because it's not going away, and I think it will only become more prominent going forward. So to summarize, and I think this should be of no surprise to you folks at this point, is that have a financial or an investment plan. And again, your advisor should be able to help you with that. Make sure the plan is in line with your values and your expectations. You can take things or borrow from others, but make sure it's your values, your expectations. I would strongly encourage a balanced approach. I don't think you want to try and become the next Warren Buffett. And I think you should be focused on hitting singles and doubles. If you strive to hit home runs all the time, you'll probably end up with a lot of strikeouts along the way. And I think that can be challenging when you're trying to manage a budget and make sure you have funding for all the projects that you'd like to undertake. So with that summary, I'll pass the presentation back to Sonia or Deirdre.
So Sonia, the financial markets seem almost solely fixated on the virus's progress. The equity markets continue to be volatile. I mean, they were up today, but that may not last. And they're showing weakness at any provocation. What is Zevon's economic outlook? And please include recession and recovery scenarios for us.
Absolutely. So in recent weeks, it's become pretty apparent that the current economic downturn is pretty severe. We've seen estimates of up to a 30% contraction in the US economy in the second quarter, and further contractions towards the end of the year. So this is an unprecedented collapse in activity in a very short space of time. The virus is still spreading, obviously, and the day-to-day life that we all had is largely on hold. And there are constant questions about how long the impacts may last, how deep this economic damage may be, and whether the extraordinary responses that governments around the world are putting forward will ultimately be enough. So global policymakers are walking a tightrope. We know that the best chance of minimizing sickness and death due to COVID infection is to implement very draconian lockdown measures for weeks and probably months. But the economic fallout from that approach is surging unemployment, massive numbers of bankruptcies, enormous wealth destruction, and economic recession or even depression. So financial markets respond to and reflect economic health. And right now, market players are trying to understand the future path of the coronavirus and how effective government policy responses will be around the world to support economies in different countries. And as we're now so much more globally connected than we've ever been, this all has repercussions here at home, even if you just invest domestically. So we think the most probable scenario at this stage is the coronavirus gets under control and the government stimulus revives the economy somewhat after a few quarters of negative economic growth. So corporate earnings will definitely sink because some firms will go bankrupt. But in that particular scenario, we don't go into a depression. A variation on that is that economic activity resumes somewhat as the stay-in-place measures relax, but that leads to a spike of new infections as people interact closely again. And so we get into this spiral of reinstating containment efforts, then torpedo any kind of nascent economic activity. So then you need additional stimulus measures to get that recovery back on track. We think the likelihood of a depression is still small, but if that happened, the economic consequences would be devastating. And that would happen if governments misstep, act too late or too little, and a prolonged lockdown to eradicate the coronavirus would ruin businesses and promote deflation. What we've seen a lot in the press is banks talking about a V-shaped recovery. We see that a lot from Wall Street. We don't think that's likely at all. That's our least likely scenario. We see these forecasts of a quick recovery in the third quarter after a collapse in the second quarter as a little too rosy. It strikes us as particularly unlikely given the financial pain felt by so many people and companies, and that's going to take a long time to dissipate, especially with the large numbers of unemployed people, especially as the driver for the US economy is consumption, and we don't think that that's going to bounce back very quickly at all. So in the weeks and months ahead, we're going to continue to analyze the latest developments in the fight against coronavirus and its impact on society, the marginalized, the global economy, corporate earnings, and obviously our clients' investments.
Thank you, Sonia and Kevin, so much for your time. I would like you just to, one of you, share a little bit about your quarterly newsletter and let people know what kinds of things they may be receiving from you. And Sonia, also, if you could highlight some of the advocacy work that Zevin does.
Absolutely. So we send out 2 things, sometimes 3 things on a quarterly basis to anyone that's interested. One is our advocacy newsletter, which talks about some of the engagements we have going on with companies at any particular time. We also talk about something that may be of interest at a particular space and time written by our equity analysts. So that could be talking about electric vehicles or 5G. And then we send out our latest economic outlook on a quarterly basis and in our performance letters to clients and those that are interested. So in terms of advocacy, we have been doing a lot with Amazon recently. That's a company, obviously, that everybody knows, most people interact with in some way. They're coming under increased scrutiny for the way that their contractors and their warehouse workers are being treated. That's always been an issue, but now people are pretty concerned. We have an open dialogue with them because what we want them to do is to link executive pay with corporate sustainability factors. What we have noticed is that if that does not happen, that often sustainability flows to the bottom and does not get highlighted. But when you put your money where your mouth is, when executives are being compensated on positive sustainability measures like labor force standards or like diversity and equity and inclusion or climate change, things start to change. But currently Amazon doesn't have that, although some of their competitors do. So that's something that we're asking for there. We are very concerned about the way this economic crisis will be borne disproportionately by poor people, by service workers in essential but low-wage jobs. And we're talking to companies about how those frontline workers are being cared for in this downturn as well. So establishing paid sick leave for people that are exhibiting symptoms is a really important step, although a lot of large employers are failing to do this. So we have been sending letters to a number of companies in our portfolio where we have some questions about what they're doing around paid sick leave right now. So, and we've been getting some interesting responses back as well. So one thing that we're urging companies to do is make a minimum of 15 days emergency paid sick leave immediately to all staff, and that should include part-time workers, temporary workers, and subcontracted workers. And we are also very interested in how these emergency policies would then extend beyond the current crisis to improve worker safety.
Thank you, Sonia. We do have a question. The question is, can you all talk a bit about what churches might expect in terms of IRA rollovers this year and how the CARES Act provisions might affect that type of giving in a church? So if that's fair for one of you to answer, I'm happy to give you the word. I will just say to our inquirer that we, the SEEP Network, are looking to provide a future webinar around economic relief, both for that which is available both for people who are self-employed, contractors, members of the gig economy, as well as for small businesses and nonprofits, which will include benefits that churches or 501c3s run by churches may be able to access. Does one of you want to answer what some of your parish clients might expect in terms of IRA rollovers this year, considering the tax relief that's just been issued in the bill?
I guess I can give it a try. You know, I think this bill that just passed, the CARES Act, is what, just a week or two old. So obviously we're very early in trying to figure out what's going on. I would say there's a couple of things that I'm already seeing happen in terms of some of my clients, and these aren't necessarily my parishes, but some of my high net worth clients, is that, and there's two reactions. You're on both sides. On the one hand, some people, while they're not panicking, they are a little concerned that the stock market has gone down so much, and when they look at it on dollar value, they've obviously lost a lot of wealth there. So you've got some of the clients that are looking at it, how much was I worth a month ago or 2 months ago, and how much am I worth now? and some might be a little more reticent to be contributing some money. So instead of where you'd normally have an IRA distribution, they might look, and since we have the option this year, they might look just to not take a distribution this year and postpone it until next year. No decision has been made with any of those clients yet, but I think it's something that they're thinking about. On the other side, I have probably more clients who are thinking about all the folks that are being negatively impacted by the coronavirus, the healthcare workers, and the fallout for all these other workers who are at home, don't have jobs, or aren't getting paid potentially for another month or two, or who knows when. With those folks, they're looking to increase their donations to various organizations so that those organizations can essentially get it into the community and help those that are most in need. So I'm seeing it a little bit both ways, and I don't feel like I have enough time to really give you a good definitive answer as to how it will play out longer term. If the stock market continues to rebound like it is today, and that continues, then perhaps, if we look out a couple of months and we're lucky and everything works well, then maybe it won't have as much impact as might be the case otherwise.
Thank you, Kevin. It's a big question, actually. And of course, there are a comprehensive and thorough answer would probably separate things out by demographics in terms of the impact that we might see. And although you mentioned postponing required minimum distributions until next year, the Act itself actually specifies that it does not ever need to be taken. It's essentially a free, you do not have to take an RMD in 2020. You don't have to make it up in future years. So it's not that you would take a double distribution in 2021. We have one more question. Let me look and see if we have time for it. Okay. The question is not a question. The question is a thank you to you all, appreciation of your time and talent and the points you provided. And I will follow up with the person asking about the CARES Act because I have a summary bulletin I can provide. If Zevin comes out with anything incremental regarding the CARES Act or economic relief, tax relief in particular related to this, we'll be happy to share it. Or you can email Sonia@zevin.com or Kevin@zevin.com, and we'll be happy to. They'll be happy to respond to you as they can. So we really appreciate, Sonia and Kevin, your leadership and your advice. Go forth and do good work. Thank you for stewardship of our time today. It's 3:52, and we are going to go ahead and end the meeting. Any final word from you, Sonia?
No, just thank you, and stay safe, stay healthy, and in the coming weeks and months, and please don't hesitate to get in contact if you have any further questions.
And Kevin?
Just thank you very much for your time and stay safe.
Okay, all. Thank you so much for your time. The SEEP Network thanks all of our attendees and speakers, and look for an announcement for a future webinar on April 20th, also at 3 p.m. on behavioral finance and investment committees. That's going to be great.